Welcome to my channel and to my new podcast, Trump's Import Tariffs, Turbulence in the Global Gold Market. If this topic interests you, then you will definitely want to check out Dr. Polleit's Boom and Bust report for investors who truly want to understand what's going on. All information is available at www.boombustreport.com. In the new Boom and Bust report, published on February the 6th, a whole range of important issues is discussed. For instance, the question, will the euro survive the Trump revolution? It is a legitimate and crucial question, as the very foundation for the single currency is about to crack, as I argue in the article. The latest edition also touches on import tariffs and the gold price, a topic that will surely interest many investors. And I must admit, I've been quite surprised by the impact of US President Donald Trump's tariffs agenda on the global gold market. Here are a few observations. Let us start with the obvious. The gold price continues to reach new heights. Currently, it is trading around $2,850 per ounce, just slightly below the all-time high of $2,883, a rise of about 40% from last year. And the price of gold is not just increasing in US dollars, but also in all other major fiat currencies worldwide. In other words, fiat currencies are dramatically losing value against gold. This is precisely what a rising gold price means. You can buy less gold with fiat money. And there are certainly many reasons behind the enormous rise in the price of gold across all major currencies. One significant reason, in my view, is that fiat currencies like the US dollar, the euro, and all other fiat currencies are increasingly losing credibility. Why? Well, readers of Dr. Polleit's Boom and Bust report are already familiar with the answer. Investors are increasingly turning to gold as a store of value, protecting their portfolios from inflation and credit default risks by holding gold and silver. However, one factor that has played a crucial role in the recent price dynamics of gold is the expectation that the Trump administration could impose import tariffs on gold and silver. Goods shipped from Mexico, Canada, and China to the US are already subject to US import tariffs. This, however, may not necessarily result in higher costs for gold and silver entering the US. After all, US buyers can still source gold and silver from other regions of the world without facing tariffs. But concerns about a general import tariff on gold and silver is already making waves in the precious metal markets. Bloomberg News reported on January 31st that the US investment bank JP Morgan plans to transport physical gold worth $4 billion from abroad to New York to prepare for fulfilling gold derivative contracts due in February. This move is likely a response to the potential scenario where the Trump administration imposes tariffs on gold and silver, a tariff so significant that it would justify transporting physical silver, which is typically delivered by ship, by plane instead to the US. And it's no surprise that US investors, fearing such an import tariff, are now increasing their demand for gold and silver. And so it is not surprising that physical deliveries of gold from derivative trades at the COMEX, which by a daily turnover of $70 billion ranks second in the world after London's $125 billion market, have reached exceptional levels. In February, COMEX is set to deliver 4 million ounces of gold from future contracts, a sharp increase from 2.9 million in January, and for March nearly 4.5 million ounces of gold are scheduled for delivery. The high demand for physical deliveries can be seen as a sign of increased tension in the market for physical gold, but particularly in the paper gold market. Both developments point to a clear and significant preference for physical material among investors. No question about it. The physical gold market is now in motion. The British press reported that substantial gold reserves have already been moved from London to the US, or at least set aside in London for eventual transfer. Reports indicate that the delivery times for gold stored in London, with the majority held in vaults at the Bank of England, are increasing significantly, from a few days to several weeks in some cases. In New York, gold is already trading at a premium over the price in London, which also provides an incentive to buy gold in London and sell it in the US. In fact, there's talk of material shortage. The lending fees for gold and silver ETFs have skyrocketed. The reason for this is that these securities are accepted as collateral for, say, gold future positions, and when physical material is especially scarce, demand for gold and silver ETFs rises dramatically in this case. It is becoming clear that a US import tariff on gold and silver would effectively fragment the global precious metals market. This is not good news. The physical gold and silver already in the US, and that is traded or delivered via futures, options and forward contracts in the US, would of course be exempt from any import tariffs. However, gold and silver imported into the US from abroad would increase in price beyond the world market price of gold due to the tariff. If private gold buyers in the US expect import tariffs on gold and silver, they have an incentive to bring forward their purchases to avoid the tariff. In particular, the COMEX would have an incentive to stock up on its gold reserves proactively, not only to potentially meet higher physical delivery demands, but also to ensure a cost-effective expansion of future trading volumes, which would be accompanied by increased demand for physical delivery material and higher stockpiles. If the rising physical inventory of gold and silver at the COMEX becomes more expensive, this would of course have an upward effect on the price of gold and silver that would be felt worldwide. Simply put, because owners of physical gold in the US would likely only sell at a price that matches the world market price plus a premium related to the US gold import tariff. The worldwide availability of physical gold and silver would be negatively impacted by a US import tariff on gold and silver, reducing liquidity in the global precious metals markets. Long term, the question would arise whether the gold derivatives market, which involves physical delivery, might shift to regions of the world where no import tariffs or any taxes on gold and silver are levied, or whether gold and silver trading could potentially move entirely to the US. But for now, there has not been a general US import tariff on gold and silver, and it's possible that precious metals could even be exempt from any such policy. Therefore, it's possible that the price component driven by the expectation or concern of an import tariff may not prove to be permanent. That said, gold investors should not be overly surprised if the sharp upward movement in gold and silver prices over the last 12 months may experience a pullback. However, it's also possible that the opposite could happen. Something truly major might occur, which would not be entirely surprising. After all, the world is, in a sense, in upheaval. So what am I getting at? I want to talk about the absurdity of the paper gold market. Rightly, for many years now, it has been criticized that the turnover in the global paper gold market, referring to the transactions primarily in the gold derivatives markets, is extraordinarily high, even grotesquely high. And the judgment is justified upon reasonable consideration. In January 2025, the daily turnover in spot and future markets was about 264 billion US dollars. That means on any given day, about 80% of the market value of annual gold production was traded. One might justifiably ask, how is this possible? It appears that the paper gold market has decoupled from the physical market, distorting the entire gold market. For many investors, gold futures, gold options, and gold certificates, as well as gold ETFs, have become almost equivalent to physical gold. With all these instruments, the physical gold market can be pyramided. Above the physical base of gold, a massive volume of gold trading exists, represented solely by financial instruments. However, if investors suddenly question this exchange relationship and a run into physical material ensues, possibly triggered by a US import tariff on gold and silver, things could get truly turbulent. The entire inflated paper gold market could dissolve into thin air with unpredictable consequences, except for the certainty that investors would regret not having physical gold and silver and only holding paper gold and silver in their portfolios. Nevertheless, there's no need to predict a grand awakening of investors or the bursting of the paper gold bubble to find reasons why the upward pressure on the price of gold and silver should continue long term, driven by fundamental factors. And one key reason, which I mentioned earlier, is that fiat currencies are increasingly losing credibility. Investors are turning to gold and silver as a store of value, protecting their portfolios from inflation and credit default risks by holding precious metals. To learn more about how investors should position themselves now, you can read Dr. Polleit's Boom and Bust report, providing real insights for the investor who truly wants to understand what's happening and seek genuine enlightenment. All information is available at www.boombustreport.com. Thank you very much for your attention.